Good afternoon, ladies and gentlemen, and welcome to the latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin, and I'm a staff member here at the OIC. We're glad that you can join us to learn more about options as a flexible and powerful trading tool. And in our webinar today, Rolling with the Market, we'll focus on managing both winning and losing positions and learn some new ways to pocket a profit or lessen a loss. And as always, we'll cover the material and your questions in a quick 60-minute session. Additionally, our previous webinars can be viewed on the OIC YouTube channel. That being said, ladies and gentlemen, I'd like to introduce our presenter today, Mr. Ed Modula of the OIC. Ed began his career in options in 1997 working with Blair Hull's trading group, and after a number of years in the pits in both Chicago and New York, Ed transitioned to helping investors in the futures markets. He joined OIC in 2014 and currently manages our investor services group. I know that we've got a lot of material to cover today, so without further ado, Ed Modula and today's topic, Rolling with the Markets. Ed?
Thank you very much, Mark, and thanks everyone for joining us here today as we start our September webinar sessions here at OIC. Before we get to our outline, we'll get there in just a minute. First, our risk disclosure. Options are not suitable for everyone. It is essential to have deep and thorough knowledge of how options operate before trading them in a live account. The characteristics and risks of standardized options is required reading material if you're going to trade options in a live account. If you don't have a copy of that booklet, please contact your brokerage firm and have them send you out a copy. We're going to go through a lot of computations today and hypothetical situations. You might want to have a calculator handy as we calculate profits, losses, and break-even points. We will not include the costs of commissions, fees, margin interest, and taxes. Those are important costs in a live account, but we will not include those costs here today. I can see we have a huge turnout for this event, which is great to see, and we continue to get a lot of newcomers, first-timers to our events. For those of you not too familiar with the Options Industry Council, or OIC, we are at the forefront of equity options education. OCC does not just clear options. They do a lot of other support for the industry, including managing risk and laying the foundation for secure markets. In addition to OCC, funding comes from the U.S. options exchanges. Of course, the clearing corporation and the exchanges have an interest in seeing that options are used wisely and effectively, so they fund the efforts of the OIC, and that allows us to support our website, optionseducation.org, and deliver presentations like the one today to our users and attendees free of charge. Let's get right into our outline. We'll begin with key concepts and considerations from a broad-based perspective. Not just for adjusting, but when you trade options in general, we'll tie those concepts into the concept or topic of adjusting. Then we'll get into our examples, starting with adjusting a long call, what you can do if the stock moves in your favor versus moving against you, and long put. I'll point out right away that the easiest way to approach this from an educational perspective is to break this down into its simplest form. That's why we're choosing a long call and a long put. A long outright option position is the easiest method to understand the philosophies behind these adjustments, but you can take those philosophies and use them for other positions, such as a short outright option or even a vertical spread. But from an educational perspective, it's certainly easier to look at it in a simple form, and that's what we're going to do today. Once we're done looking through the calls and the puts, we will have a section at the end of the presentation which defines some special risks and considerations when you're trading options and making adjustments. So we'll get started. When you trade options in general, of course, your forecast has to come first. Your opinion of the underlying, your market directional bias comes first, and the options trade follows that. Making adjustments is similar to that, although you're not starting from scratch. You have an existing position, but options traders are monitoring that position and constantly deciding whether or not the trade they have still fits their market bias or market outlook. Once you make that determination, you have a decision to make. What do you need to do? And it certainly may include making an adjustment to your position. Sometimes when you make adjustments, you have to pay for them. You have to increase your cost or your total investment. Sometimes you'll get a credit and reduce your overall cost, but you don't know what situation you'll be in until you get there. So you see the word flexibility here. It is important to consider having some cash in your account so you have the ability and flexibility to make trades. If you do need to incur a debit to make an adjustment that benefits you, you want to have the flexibility to do that. It also goes without saying that your account needs to be approved for this type of trading. The reason is that we'll be opening up short positions and transitioning trades into spreads. Our examples do not include uncovered short positions or net short options, but we certainly do hold a short option or open up a short option, and you'd make sure your account is approved for that. Also, exercising and assignment is important because we'll have long and short options. You want to be very familiar with your brokerage firm's procedures. What do they require of you to communicate to them, your exercise instructions, and what procedures are involved for them to communicate to you when you're assigned. You want to be very familiar with that. And then to drive home further the concept of tying your market outlook and bias to the options trade, as we go through each example today, we're going to define a certain circumstance. And it will either be with the stock having moved in your favor or the stock moving against you. Now, it's far more frequent that I get questions from traders and investors who are asking about adjustments they can make if the stock has moved against them. They generally try and salvage the trade or reduce their risk or try and bring back their account to break even. It's far less frequent for me to receive questions about how to manage a position or make an adjustment when the stock is already going in their favor. So you certainly can do both. We'll spend a lot of our time speaking about adjustments you can make if the stock goes in your favor, because I think it's a segment to options trading that might be overlooked a little bit. But each example that we go through can generally be done whether the stock has moved in your favor or not. But for our purposes today, we're defining a certain circumstance, and then we're discussing the philosophy behind an adjustment from there. Now, options traders are active, and once your position is established, you have a decision to make. You'll be monitoring the market and monitoring your position and asking yourself questions. How is my position performing, and why is it performing in that way? Is the stock doing what I expected it to do? Is my option position satisfying me with its profit or loss, or do I need to change something? Ultimately, you have a decision to make at some point. Do you hold the position as it is? Do you exit the position and move on to the next trade? Or before doing that, do you make an adjustment of some kind and hold a new position that has a different risk profile attached to it? And that leads us into our first poll question. Question at the top is, how do you currently manage your positions? And this is specifying after they're opened, what's generally the next step that you take after you've opened an options position? Are you normally tracking it, do nothing, track it till expiration, and seeing what the results are? Or after opening a position is generally your next course of action to look for an exit opportunity. Maybe that's on the plus side, maybe that's on the minus side, taking profits or reducing losses. But you might be looking for an exit strategy there. Or number three, are you more apt to make an adjustment and do something to change the risk profile of the trade? Now, I'll point out here that ultimately you're making one of these three decisions all the time. You just might be making those decisions by default. For example, if you open an options trade and didn't do anything at all, didn't even track the trade, then by default you're doing nothing. If you're opening an options trade and immediately looking for a profit target on the upside or cutting your losses on the downside, then you're almost by default choosing to buy, sell to close, and exit the trade. So by default, you're making one of these three decisions at all time, and the results are coming in quite quickly, so we'll go ahead and put those on the board. Very interesting here. Buy, sell to close comes in as the winner, which is no surprise. Most options trades are exited and closed before expiration. I was curious to see where adjustments fell into the mix, and it looks like more than holding it till expiration, which is nice to see. A little bit surprising. I was expecting adjustments to come in third place, but here we are seeing at least a third of our audience, or approximately a third of our audience, making some kind of adjustment. And so hopefully when we go through our examples today, we'll give you a few more things to think about and consider. We'll get started with the long call position and start to define different examples here. First of all, we have the initial position. We're bullish on stock XYZ. It's trading at $50 a share, and we think it's going higher, specifically up to $60 a share within 2 months. So we check out the June 50 calls, and they're trading for $300 each, and we buy 10 of those for a total cost of $300. Now, I assume our audience is very familiar with the P&L graph of the long call position, so I will not go through the numbers individually on the right. I'll just point out break-even point is when our option is worth what we paid for it at expiration. That occurs if the stock's at 53. Profits above that, maximum loss. If the stock finishes at expiration at 50 or below, we lose our entire investment of $3,000. So our first scenario starts with the stock moving higher. And here it's moved from 50 to 56. We have about 3 weeks left till expiration, so our price target has not been met in this case. We're still bullish, but we're a little cautious now. We're running out of time. Theta decay is starting to pick up on us, so the forecast is what I'm going to draw your attention to here and on all of our future examples today. We're bullish, which means we still want to hold a position and want to be long delta, but we're cautious, so we might not necessarily want to be taking the level of risk that the current position holds. Now, one action you can consider is sell a portion of the contracts you hold to cover a portion of your investment, in this case the $3,000 investment. This sounds very simple. I included it in the presentation because it is surprising to me how often investors don't consider this. In our specific case, if the 50 call is trading for $6, let's just say we don't have any time value on there, you would be in a position to sell 5 of those options that you hold for the entire $3,000 that you originally spent and change this P&L graph into something that looks like this. That might seem like an easy decision to do. Take all of your risk off the board and lock in profits above $50 a share. The stock's already above there. So this is certainly logical and reasonable and consistent with our market forecast, but it's still useful to look at the P&L graph because you can see by changing the number of contracts you hold, your leverage to the upside is reduced. So even though it sounds like a great idea, we've reduced our overall risk, we've increased our break-even point, and we've got ourselves a nice-looking, comfortable trade. To the upside, we give up potential gains if the stock does rally sharply. If we do get to 60 and beyond, holding the 10 calls originally may be the better trade. So it may give us pause looking at this P&L graph, or at least ask ourselves to reconsider our market outlook and make sure we're comfortable with it before making this type of adjustment. Now we'll move on to our next example. Similarly, the stock has moved up to $57 a share, about 3 weeks left till expiration. We still think the price is going to 60, except it's not happening as quickly as we thought it would. So we're still bullish. We still think 60 will happen. That means we want to hold long deltas, but we don't have enough time for that $60 strike target to be met. So we buy more time. The action here, roll out to further expiration, otherwise as known out. Now we're going to put a little bit of a wrinkle on this to give you something to think about. It certainly would be reasonable to sell the options we own and buy options with a further out expiration date. We're also going to manage our money at the same time, and we'll see how that works here. Management you see at the top, selling the June 50 calls and buying a certain number of July 50 calls, and that's the wrinkle that we're putting on this. We're not going to buy 10 July 50 calls. If we did so, it would cost something. We'd have a debit and an increased cost to our investment. So if we change and we buy a fewer amount of July 50 calls, we can do so maybe at even money or maybe with a slight credit. We're going to change the risk profile completely and lower our break-even point and decide just how many July 50 calls do we want to buy. Well, here's numbers. We're going to use a lot of premium amounts in our examples today, and I will point out that we're not conveniently choosing our premium amounts. They're realistic numbers, but hypothetical for sure. We sell our June 50 calls for $720 each. That brings in $7,200, and we look and see that the July 50 calls are trading for $775 each. Now we can decide how many we want to buy. In this case, we decide to buy 8 options. That keeps us long delta. That gives us more time. And because we're only buying 8 and spending $6,200 on that 8, we've actually rolled out in time and received a credit to do so. Our original $3,000 investment has now been reduced and has become a $2,000 net investment. That's our max loss. So we've started with our original June 50 call options, and now we have adjusted to July 50 call options. When you're looking at these P&L graphs, something to make sure you're considering is the difference in time frames. In this example and in some others as we go through the presentation, I'll continue to call it out. Comparing these P&L lines on a chart is not a direct comparison because one line represents June and one represents July. So you have to keep that in perspective as you're evaluating the risk and the potential reward on each of those trades. Now, break-even point has been improved. Our overall risk has been improved. We've given up some leverage to the upside. All of that, keeping in mind we have more time because we rolled out to July. I'm going to point out, where does that break-even point come from? It's been improved. How did we get there? All right, remember, our total investment now is decreased. We have spent $2,000 on this investment, the original $3,000 minus the credit on the roll. So at expiration, the 8 call options that we own would need to be worth a total of $2,000 in order for us to break even. In other words, if you take that $2,000 and divide by 8, that means each option has to be worth $250 at expiration. Keep going with that mindset. Each option has to be in the money by $2.50. That happens when the stock expires at $52.50 versus our July 50 calls. That's where the break-even point comes from. Our total investment divided by the number of calls that we own. That tells you how much each call needs to be worth, and then you adjust versus your strike price to determine break-even point, and that's rolling out. Our next example, stock has moved up to our target price, but it moved there very quickly. We still have a month left to expiration. Great news is coming out about the stock. It's getting upgraded. Price targets are getting increased. All of a sudden, our forecast has changed, and we are increasingly bullish. We are aggressively bullish. So the June 50 calls, in this case, we see trading for $10.15, but we decide we want to adjust this position to be more aggressive. We've raised our price target, and we want to extend our time frame. An adjustment that we can consider would be to roll up and out. So we're rolling out in time, such as what we just did, and we're rolling up in strike price. As we move up in call strike prices, the premium amounts will be decreased. It will allow us to buy more and more options. So we have 2 different examples of this, and we'll plot both of these on the following graph on the next slide. We have the 10 June 50 calls for $10.15. If we sell those, we could bring in $10,150. We look out to July. We see the 55 strike trading for $6.50 each. We decide how many do we want to buy. Do you want to buy 10? Do you want to buy 15 or 20? It's up to each investor. In our case, we decide to buy 15. That gets us very close to even money, but actually gives us a slight credit of $400 and reduces our net investment down to $2,600, and we'll see that plotted on the P&L graph on the next slide. Another possibility would be to look out to July and up to the 60 strike. They're going to be cheaper. They're trading for $3.50 or $350 per option. We decide to buy 29 of those. We chose 29 conveniently because it works out to be an even money rollout. We spent $10,150. That's what we brought in from June. So our net total investment remains $3,000. Now let's see how these positions compare to each other. Here's our initial position. Again, this is June. Our rollouts are July. So we're buying time. When you're comparing this, realize that you're buying more time along the way. And notice what this does. We received a slight net credit to buy the 55 calls. So our total risk has been reduced to $2,600, but we will experience that total loss if the stock is at 55 or below. Again, that's going out to July, but our total risk is lowered. That risk will be realized at a higher stock price. So that is as a benefit and a cost at the same time. We start to profit as the stock moves above 55, and because we bought 15 options, we have leverage, and we're going to start making money at an increased pace as the stock keeps moving higher. So this is consistent with being aggressively bullish and expecting the stock to go through the 60s and possibly through 70 as we move forward into July expiration. Let's plot the 60 calls up. We know we bought 29 of those. Let's see what that looks like. Well, this is done at even money, so our total risk is the same, $3,000. We would experience that loss if the stock was at 60 or below. Keep in mind the stock is already at 60. That's where it moved to. But then because we have 29 calls, our leverage is greatly increased. If the stock does rally as we expect through 65, through 70, and above, having 29 calls would certainly increase our leverage and increase our profits to the upside. We'll go through a break-even point on one of these. Let's look at the July 55 calls. We have a net investment of $2,600 in that example, the original investment minus the small credit that we received for the rollout. So $2,600 divided by 15 is $173 at expiration. Each of our July 55 calls would need to be worth $173 for us to break even. That would bring the total of 15 options to be worth $2,600. Knowing that the multiplier of options is 100, we take $173, divide it by 100, that's $1.73. This means each option would need to be in the money by $1.73 for us to break even at expiration. If our strike price is 55, that means our break-even point is 56.73, and that's how that is calculated. You do it the same exact way, calculating the break-even point for the 60 call. So you can see here, you're buying time, you're buying increased profit potential to the upside. You might not be changing your overall total risk, but you will be changing the place where that risk is realized, and it will be at higher and higher levels. Next example with the stock moving in your favor. Here it's gone to the same price, to our target price of 60. Happened in a month, so we have 30 days left, and we're going to change the price a little bit on the June 50 calls to distinguish from our previous example. Here it's worth $10.20. And now we're neutral until expiration. I'm going to emphasize neutral with this particular position adjustment. We are not bullish any longer, and we are not bearish. That means we are confident that the stock is not going in either direction, and that it will consolidate and remain neutral right around 60 up until expiration. Certainly in this case, we can consider selling the June 50 call for $10.20 and being done with the trade, moving on to the next trade. Or we can attempt to increase our profit on this particular trade by spreading off those long calls and selling an at-the-money call and turning our position into a bull call spread. We look out into the open market and we see the June 60 calls trading for $2.40, and that gives us an opportunity. See at the top of the screen here, if we sold the calls right away without making any kind of adjustment, we'd receive $10,200. We paid $3,000 for the trade, so $7,200 is our net profit, and we can put that in our pocket and move on to the next trade. Or if we decide to sell the June 60 calls for $2.40 each and sell 10 of them, that would actually bring in $240. You see at the bottom of the screen, our net debit between the two trades is just 60 cents. We paid $3 for the 50 calls. We are now selling the 60 calls for $240. That means our total cost, our overall net investment is now just $600. That's 60 cents times the option multiplier of 100 times 10 contracts. $600 total investment. Let's take a look at how that compares on the P&L graph. And I will point out that the spread is in the same month. So these P&L graphs are very comparable, although what we're really comparing is the spread versus selling the option for our $7,200 profit. Let's take a look at how this looks on the graph here. If the option did remain neutral and consolidate right around $60 a share, then we would actually increase our profit from $7,200 to approximately $9,400. That is the difference between holding the option outright and selling another option to increase your premium amount. We've received premium, we've increased our profit potential. Now, to the downside, we still have risk. Of course, if we sell the option, we take the profit and move on, we've taken all of our risk off the table. We turn this into a spread and we're wrong, and the stock sells off, we still could lose money. In fact, we'll start to lose money gradually as the stock starts to move below 60. If it moves above 60, we're still okay with that. Our option spread has reached full value of 10. We keep the premium on that 60 strike, so we'll still be okay if the stock moves higher. But because our forecast is neutral, we're specifying that 60 strike. If it stays right there, as opposed to selling the call we own for $7,200, if we increased our profile by bringing in premium, selling the 60 strike price call, we could potentially increase our overall profit on the trade by a significant level. So that's spreading off into a bull call spread. Now we'll look at a few examples if the stock moves against us. So we have the same original trade. We're long 10 June 50 calls. And one thing I'll point out here is most of our questions, and most of the questions I receive from traders and investors are looking under the circumstance of the stock moving against you. If the stock has moved significantly against you and the option you hold has very little value left, there's not too many choices to make adjustments. There's nothing magical that you can do to wave a wand. I wish there were, but when your option has lost most of its value, it's tough to salvage there. So the few examples we have here are looking at a situation where the stock has moved a little against you and your forecast maybe has changed. In this case, the stock's gone down a couple of points, down to 48. We still have time to expiration, but our option now is in the red. We've lost 80 cents on our option as it's only worth 220. We're still bullish, but we don't think it's going all the way to 60. We're now more cautious, and we think that a bullish move to the upside may reach 2 and into the 50s, but not much higher than that. So we still want to be long delta. We still want to be long delta and capitalize on a move higher, but we just don't think it's going to our original target price. One action you can consider is to roll down into a bull call spread, and this one is going to look fairly complex, but I think you'll enjoy seeing how this works. I'm going to break up the top of the screen into two parts. Remember, we own 10 of the June 50 calls already. Now, what we really are doing here is selling those 10 off, and then subsequent to that, buying a bull call spread, buying 10 June 45s and selling 10 June 50s. Put those two things together, and we're effectively selling 20 June 50 calls, 10 of them to close and 10 of them to open, and buying 10 June 45 calls. Using the numbers on the board, we do that entire trade for a small debit. We've increased our net investment. Our total cost on the trade now is $3,200, and we have a position that looks completely different. We now own 10 June 45-50 call spreads. This is going to drastically change our risk profile, as we're going to see on the next slide. The best way to visualize and compare one trade to the next is to see them on a risk profile chart like this. So here's our original position. And after we put the call spread together, here is what we have. Notice we've slightly increased our overall risk from 3,000 up to 3,200. We've reduced our potential gain dramatically. If the stock rallies back where we thought it was going to go, then holding the June 50 calls would be a much better trade than turning this into a spread. But look at where the benefit is. We've dramatically reduced our break-even point on the spread. And look at how these numbers work out. In order to calculate the break-even point, you take our total new investment, that's $3,200. Each one of our spreads needs to be worth $320 in order for us to break even at expiration. That means that 45 strike price call option needs to be in the money by $3.20. That happens when the stock trades at 48.20 at expiration. That's our break-even point. Clearly much lower and more favorable than the original break-even point of 53. This is a method used to salvage a trade that is losing by lowering your break-even point by a large amount. You're giving up a little bit on the downside risk by paying, in this case, a couple $100. You're certainly giving up upside potential. Above 50, the long option and short option cancel each other out, but we do that for the benefit of lowering our break-even point, and that is consistent with our market outlook. We're still bullish, we're still long delta with this spread, but we really don't think it's going to 60 anymore. We're anticipating that the stock might rally into the 50s, so the spread profile as compared to our market forecast looks a whole heck of a lot better. Let's take another example with the stock moving against us slightly. In this case, the stock has moved down from 50 to 49. We have 6 weeks to expiration. The June 50 calls trading at $1.90. Market's consolidating, volatility is getting crushed, and our option value has been reduced dramatically. We are still bullish. We still have our price target of 60, but we certainly need more time. This move to the upside just has not occurred anywhere near the time frame we expected. So we want to roll out to a later expiration, and we're going to do a similar tweak to that as we did earlier with our number of contracts. In this case, it's not going to work out as nice because we can't afford to buy as many options. We're not selling something that has much value like we did before when the stock moved in our favor. So our 10 calls trading for $1.90 each can bring in $1,900. If we look out to July and see the 50 calls out there trading for $265, notice right away if we bought 10 of those, it would increase our cost. That would have to be done at a net debit and increase our net investment and our total risk. So because we're managing our money here, we decide to just buy 5 of those July calls. We do that as a package for a net credit of $575. Our new now investment is $2,425. Something to note, point out if you haven't noticed, in this case, the stock moved slightly against us. We rolled out, we've created a new position that is still bullish and still consistent with our market outlook, and our overall total risk has been reduced. Those are all benefits. We did that because we were willing to give up upside potential. We now only own 5 call options, so our leverage to the upside certainly has been reduced. But we're doing so because we've given ourselves more time, and again, it's consistent with our forecast. Remember, we still think the stock is going to 60, and we've given ourselves more time. These P&L lines in comparison, again, have to be looked at a certain way because they're at different time frames. We started out with a June option, and now we're rolling out to July. So that upside doesn't look anywhere near as good on the July, but we've also got one more month and more time for those Julys to pay off. So those are the adjustments on the call side, and this brings us to our next poll question. If you haven't used these scenarios or used these methods before, of the ones we just discussed, which ones would you most likely use? And what we have coming up is a put section, and we're going to follow the same procedure and follow the same format as we did before, but we're going to look at it from the perspective of the puts, and we're going to go through our examples one by one. And again, in this case, let's go through our choices here. Which ones would you most likely use, or which ones would you be most interested to use? Recover investment is selling enough contracts to recover a portion of your investment. Rolling out is simply giving yourself more time and rolling out to a further expiration date. Rolling up and out would be going out in time and changing your strike price and likely the number of contracts you hold to increase leverage. And then spreading off would be changing the risk profile, reducing your break-even points, and changing your original long option into a bullish or a different kind of a call spread with a long and short option. With spreading off, you certainly give up something to the upside, but you have given yourself an opportunity to break even on the trade and salvage something that otherwise wasn't working out in your favor. So we'll get some results to come in through here, and we'll see where we stand on this poll answer. So thank you very much for your responses here. Roll up and out. Increasing your leverage certainly has taken the prize on this question. I think what we'll do is we'll maybe elaborate a bit on the others when we go through the puts a bit, but we still have the same scenarios to go through on the put side. Thank you very much for your participation on that one. Almost even across the board here. So all of these different scenarios might be favored by our audience. And now we'll get into the put section. Here, our initial position, we're bearish on XYZ stock. It's trading at 70 right now. We think the stock's going down to 60 in 3 months' time. So we look out to May when our forecast time frame is telling us the stock will hit that level. And we see that the May 70 puts are trading for $4, $400 each. We buy 10 of those for an investment of $4,000. Here is our long put P&L graph that we're going to see over and over again as we go through this. Break-even point is when our option is worth the $4 that we paid for it. Maximum loss is going to be incurred when the option expires, worthless at 70 or above. So now here we go with the stock moving in your favor. In this case, XYZ moving down. Here it's moved significantly down. It's moved from 70 to 62. We've still got a month left to expiration. We've got a nice healthy gain. We still think it's going lower, and we're bearish but cautious. Similar to the calls, we're going to follow the same format here, but look at it from the opposite side. We sell enough contracts to recover our $4,000 investment. Very simple, very logical, but again, not as thought of or considered when I speak to investors and traders as much as you might think. In this case, we sell enough contracts to recover all of that $4,000, and here's our P&L graph. After having sold those, we hold 5 instead of 10. Our leverage is decreased. We want to look at this on a P&L graph and make sure that we're comfortable with this. It sounds great. Sell enough contracts, bring in 4,000, reduce all of our risk. But if we're correct and the stock goes to 60, or if it goes even further down to 55, we would have been better off just holding the 10 May 70 puts. So it sounds like a very easy, logical step to take. Sell enough contracts, put money in your account. But looking at the P&L graph may give you pause and at least ask you to confirm the opinion that you have before going ahead with the adjustment. Now, next case, stock has moved in our favor down to 65. We still have 3 weeks left. Our forecast stays the same. We still think the stock's going down to 70, but again here, the theta effect is starting to creep up on us as we're reaching expiration. We want to buy more time, so we're going to roll out to a further expiration date. We're going to buy ourselves more time, and you remember what we did before, we're going to manage our money. The May 70 puts that we own are trading for $620 or $620 each. We can sell 10 of those for $6,200. We look out to June to buy us more time and see that those options are trading for $750 each. So we decide to buy 7. As an investor, you can decide how many you want to buy. Could be 5, could be 2, could be more. But we decide to buy 7 to manage our money a little bit more to our liking. We spend $5,250 on that and do this rollout for a credit of $950. That means our new investment is now $3,050. The original 4 we spent minus the credit we just received to roll out. Now plotting these on the graph next to each other from a P&L perspective. Let's see if this chart, there it is. Here's our original position, long May 70 puts. We're familiar with that. After we roll out, here is what we now have. Now again, this is one of those different time frames. When we're comparing this, we say, okay, the break-even point was 66. That's what we have now. If I roll out to June and get this small credit, my break-even point is actually a little worse. I'm bearish, but the stock needs to go lower, down to 65, 64. So I have not improved my break-even point. I've made it worse in this case. But keep in mind the time frame. You have another month. You may consider that and think, well, maybe that break-even point is actually better. Even though it's 36 cents lower, you've got another full month to see that come to fruition. So that break-even point is not a direct comparison. We have a smaller total potential loss after the roll because we did this for a credit. To coincide with that, we have less leverage. The reason why we got a credit in the first place was because we bought only 7 options. But that also reduced our leverage to the downside. If the stock sells off down to 60 or 55, before May expiration, we would not make as much as we would if we just held the May 70 put. But again, that time consideration, when you're comparing these P&L graphs, they are not a direct comparison because you have May and you have June next to that. So with that, we are almost right on time here, so I will turn it over to Mark in a second. First, I want to encourage everyone to visit optionseducation.org, our website. Also visit our YouTube channel, the Options Industry Council on YouTube, and please send email questions to us. options@theocc.com is the investor services email. So me and my team will answer your questions, whatever you have about options. Again, that email address, options@theocc.com. And since we're going through on time here, I will turn it back over to you, Mark.
Well, thank you, Ed. We have a question from Frank that I know that you had just spoken recently about pin risk. Could you go over that a little bit again and explain that a little further, please?
Sure, yeah, and it's a good question because it is very important. Pin risk specifies a situation where you are short an option and you're not sure if you're going to be assigned. Generally, that's because the stock is trading very close to your strike price. When you have a short open option, you can never be sure. By definition, you can never be 100% sure if you're going to be assigned or not. Of course, if the option is deep out of the money, the likelihood of assignment would be extremely small. If it's deep in the money, the likelihood of assignment would be very large. But if it's at the money, you really don't know what might happen, and an option holder, they can decide what to do with their long option at their discretion, even if it's illogical. They certainly don't have to wait for an option to finish in the money, or in other words, an option doesn't have to qualify for exercise by being in the money. So being short an option and not knowing if you're going to be assigned and what the resulting position you may have in your account will be, that's what pin risk is. Now, as I said earlier, there's two ways to approach that. One would be to accept it and to understand, I'm not sure if I'm going to be assigned on these options. I may get assigned on all of them or some of them, and I'm okay with that. It's certainly reasonable to decide that you're comfortable with assignment and to go ahead and accept it on the next trading day and manage the position from there. The other approach would be to decide, I'm not comfortable with assignment. I can't tolerate it. I don't want the stock position. I'm not sure if I'm going to be assigned, and since I cannot tolerate it, I have to close that position out. I have to buy to close and execute that transaction before the closing bell on the last trading day, or else I risk being assigned. And to point out again, for equity options, they will trade on their last trading day. So you have until the closing bell on the trading day to close that option out if you can't tolerate assignment. And in a nutshell, that's what pin risk is.
Terrific. Now, Ed, Carol is asking, when it comes to Greeks, in particular delta, do you pay attention to that when adjusting a position? Do you worry about what the delta is for the new option that you're selecting?
It certainly would benefit you to do that type of analysis. We didn't focus on the Greeks today. We were really comparing our original risk profile to an adjusted risk profile with a new position. But certainly incorporating the Greeks into your analysis is something that is always helpful. The more information, the better. And I'll say this in a more general statement, each investor is going to decide for themselves what type of analysis and approach they're most comfortable with. Some investors may pay close attention to delta and the comparison between what they have and what they're rolling out to or adjusting to. Other investors may not. It'll be up to each person to decide how to do that, but certainly you can track your deltas as they sit in your account today. Look at your delta if you make the adjustment, and just as before, to keep things simple, know what your market outlook and forecast is and compare those to each other. As we said in the very beginning, when you trade options, you start out with a market forecast and an opinion, and you create an options trade from there from scratch. Adjusting works the same way, except you're not starting from scratch. You have a position. You're continuing to monitor the stock and the underlying and update your market outlook and your market bias. And as you do that, you're then evaluating your existing position and tying it to your new market forecast. You might decide to hold as is. You might decide to close to exit. Those are perfectly reasonable choices to make. Our presentation today was focused on choice number 3. Don't close it out, but don't hold it as is. Change it into something else. And when you do that analysis on what do I want to change to and how do I want to change this position, certainly looking at delta is a viable choice.
Okay, terrific. Let's go to Sylvia's question. Sylvia is asking, how do we adjust for a short call or a short put? I know a lot of these scenarios that we were looking at were long positions, and we certainly know the risk of short positions, certainly when they're short uncovered positions. So how would you adjust for a short call, for example, if it goes against you?
Mm-hmm. Well, that's a very good question. I'm not going to deflect the answer, but I'll just say it this way. Certainly, very different risk profile exists when you have those short options, especially for the long call. As many of us know, that's arguably the most risky trade that an options trader can make is the short uncovered call position if you happen to have one. And you're looking to adjust it, really you can follow the similar method that we did today. For example, rolling out to a further expiration date would entail buying the short option that you have near term and selling an option with a further out expiration date. So you can just translate what we've done here today. But again, that long call position specifically stands out as one that carries a lot of risk attached to it, and you'll have to have special considerations and certainly the highest level of options trading approval to sell an unexposed naked call. Now the put is also different. It gives you something different to think about. A lot of investors are entering into a short put position because they're comfortable with assignment and they don't mind owning shares of stock. That's certainly something to consider. So short put or put sellers may not necessarily be interested in making adjustments and changing their options position because they might not just be trading the option itself. They could be circumventing their stock trades by selling puts. That's the first thing to say about that. If you are trading puts and selling them as an outright options trade, then again, you can follow what we've done here and just flip things around a little bit. If you decided to recover your investment, of course, that would entail buying some of your options back. If you wanted to roll out in time, that would entail buying the short put in the near term, selling one out in the far term of whatever quantity you wanted. Spreading it off is something you can also do using the same methods and philosophies that we discussed today, just translating them and changing a few plus signs into minus signs, but utilizing the same methods that we did today.
Okay, thank you for that answer. Stan is asking that all of the examples that we looked at today were dealing with at-the-money options. Is there any difference between in-the-money options and how to manage those positions versus an at or out-of-the-money option?
Well, there really isn't a difference. If the stock is far deep in the money, or if an option is far deep in the money, one thing I'll say is this. If you own calls or own puts and it goes very far in your favor, then all of a sudden that option starts to behave more and more just like having a stock position. So it's still an options position, but it behaves like a stock, and it increases its delta and approaches a 100 delta, which of course would behave exactly like a stock position. So you might be managing that more like you would just any stock position and maybe trading options around it. But if the option goes in the money, we did talk about maybe spreading it off and selling some at-the-money options or doing something rolling it out and up in time. If you had a stock that moved in your favor, one of our examples today was of the stock moving from 50 to 60 and being more bullish and still wanting upside exposure, rolling out, rolling up, and buying more contracts. So there certainly is some things you can do that apply today. One thing I did mention earlier that I'll repeat again, if the stock has moved the other way and moved against you in a significant way, and your option has lost most of its value, your hands are mostly tied there. It's a lot more difficult to manage a position or to make an adjustment of some kind to salvage the trade when the option that you own has a value that has been diminished so significantly. To take that explanation to a more extreme level, if you buy an option for $3 and the stock has moved so far against you that that option has no value at all left, has nothing left, there's really not much you can do, if anything, to change that and salvage the position because what you own doesn't have any value. So, of course, on that side of the coin, with the stock moving significantly against you, we didn't have any examples today. But we did go through a few when the stock stayed right around your strike price and a few when the stock moved in your favor and your option went in the money. So there certainly is potential there.
How about weekly options, Ed? We were talking about rolling out to another month and managing time expectations. Is it any different if you're dealing with a shorter time frame, such as a weekly expiry?
A really good question, and I'm glad that one came up. I get a lot of questions about weekly options. Traders seem to be very interested in trading them. The first thing I'll say right away is the direct answer to that is no. There's no difference. Weekly options versus monthly options are exactly the same, but except there are more time frames and expiration dates available because of weeklies. One point that may or may not apply, but it's worth mentioning since the question came up, is the idea of over trading. When you make adjustments, if you continue to make adjustments, you're certainly buying and selling more options than you otherwise would if you just held your position to expiration, or if you just entered closing orders and moved on from there. If you make a lot of adjustments, you're trading a lot more. So you may want to consider your commissions and your costs involved with doing those type of trades. It's relevant to this question because weeklies might mean you're trading and making investments so often, adjusting your positions, that your commission charges start to increase. So that's just something to consider. But certainly your market outlook and your market forecast might be pinpointed to a weekly expiration, which makes perfect sense to adjust your options position to that weekly expiration. That's one of the great benefits that weeklies have brought into the marketplace, is when you have a forecast doing your technical analysis or your fundamental analysis. You're now not just limited to monthly options. You may have a forecast that targets a certain price on a certain day, and there's a very good chance that there's an option listed very close to that target price expiration day because of weekly. So that's one of the benefits there. In a nutshell, weeklies behave and act and have the same characteristics as the monthlies. So as an overview answer to that question, there would not be a difference between the two.
Okay, that sounds good. That's all the time that we have today. And while we weren't able to get to all of your questions, we do have our Investor Services desk ready to help, and feel free to reach out to them at options@theocc.com. In addition, many of our other webinars are available on our YouTube channel as well. I also want to make sure that everybody has the information to check out our website, optionseducation.org, and also like us on Facebook, follow us on Twitter at options_edu. Also on our website, you can find further information as to our next presentations, both live and online. So I just want to take this opportunity to thank you for attending, and we hope to see you very, very soon. Thank you.